The tremendous growth of target date funds on DC menus, coupled with the Department of Labor's recently mandated fiduciary standard, has prompted an increased focus on fees. In this new regulatory environment, many financial advisors assume that by simply recommending the lowest cost option, that is, a target date fund using only passive underlying strategies, they are meeting their fiduciary obligations. However, like retirement planning itself, conducting due diligence for target date funds is a much more complex process that goes beyond the active-passive decision. At Voya, we believe that the notion of a purely passive target date fund is somewhat of a fallacy. Even passive target date funds are required to make a series of active decisions. One important component of a target date fund that reflects an active decision is the glide path. That is the equity and bond mix leading up to and into retirement. And as you can see, there is a glaring dispersion in equity allocations across target date managers, which reflects a lack of consensus in the industry. A key factor in an advisor's analysis is whether the glide path is appropriate for a plan's participants. Are the participants able and willing to accept more risk in their portfolios to see greater returns? Or is wealth protection the greatest concern in the years leading into retirement? Because glide path design is proprietary to each investment manager, even passive target date funds exhibit wide dispersions in their equity allocations and subsequently their returns as well. As you can see, deviations in calendar year returns between 5 of the largest passive target date funds have been as high as 741 basis points. At Voya, we believe another crucial factor to keep in mind when evaluating a target date fund is whether the fund provides sufficient asset class diversification to meet plan objectives. In general, passive target date managers tend to offer fewer asset class exposures, particularly with respect to fixed income and non-traditional or alternative asset classes. This is because these asset classes can be difficult and/or costly to replicate passively. It is also important to understand whether the target date manager has a strategic approach to asset allocation, changing the asset class mix fairly infrequently, or has the flexibility to make short-term tactical moves to be more responsive to changing market environments. Finally, evaluating the underlying fund options within a target date fund requires the advisor to consider the architecture approach to selecting underlying managers. Are the underlying funds of the target date diversified across various investment managers throughout the industry, or are they all managed by a single investment firm? The plan's philosophy and approach regarding its menu of standalone investment options may provide a guide as to what target date approach is most appropriate for the plan. We at Voya believe using a broader set of criteria to evaluate target date funds enables advisors to deliver insights and solutions more aligned with the investment objectives of their clients and ultimately help lead to better retirement outcomes for their participants. And I think most of us would agree that this is the ultimate goal of the DOL's new fiduciary standard.